Alex spent 11 years making his coffee at home. Every morning, no exceptions. He tracked every dollar saved in a spreadsheet. By his calculation, he'd avoided spending nearly $18,000 at coffee shops. He was proud of this. Then, his car transmission failed. The repair cost $4,000. He didn't have it. He put it on a credit card at 22% interest. Here's the thing nobody tells you about saving money. You can do everything right and still lose. The personal finance internet has convinced millions of people that wealth is built through discipline. Skip the latte, cancel the subscription, cook at home. And sure, those things help, but they're also a distraction from the actual mechanisms that either build wealth or quietly destroy it. Because the uncomfortable truth is this: the difference between financial security and financial chaos often comes down to 5 specific structural decisions that have nothing to do with willpower. Most people get at least 3 of them wrong, not because they're lazy, not because they lack information, but because the systems themselves are designed to be confusing. And confusion is profitable for someone, just not for you. Stick around, because number 3 is probably costing you more than your rent. So let's talk about the 5 money fixes that actually matter, not the ones that make you feel virtuous, the ones that change the math. Fix number 1: where you keep your emergency fund is probably wrong. Most people know they need an emergency fund, 3 to 6 months of expenses. Basic advice, common knowledge. What's not common knowledge is that the average American emergency fund sits in a checking account earning 0.01% interest, which sounds like a small problem until you actually do the math. Let's say you've saved $10,000. Congratulations, that's better than 63% of Americans. But if that money sits in a standard checking account for 5 years, you'll earn about $5 in interest. Meanwhile, inflation over those same 5 years, at an average 3% annual rate, erodes about $1,500 of that money's purchasing power. You didn't spend it, you didn't touch it, but you lost $1,495 anyway. Now here's where it gets interesting. If that same $10,000 sat in a high-yield savings account, which currently offers around 4 to 5%, you'd earn over $2,000 in interest over 5 years. That's a $2,000 swing for doing literally nothing except opening a different account. But most people don't do this. Why? Because their primary bank doesn't offer competitive rates, and switching feels like work. So the money just sits there, quiet, obedient, shrinking. And that's just the emergency fund. Wait until you hear what's happening with your insurance. Fix number 2: you're getting robbed by your own insurance company. Here's how this works. You sign up for car insurance. They give you a competitive rate because they want your business. You pay it for a year. Then the renewal notice comes. The price went up by $80. You think, inflation. Makes sense. But here's what actually happened. You became a loyal customer. And loyal customers are the most profitable customers because they don't shop around. Insurance companies have entire departments dedicated to calculating something called price optimization. It's a fancy term for figuring out how much they can raise your rate before you'll bother to leave. They're not pricing based on your risk, they're pricing based on your inertia. One study from the Consumer Federation of America found that insurance premiums can increase by 20 to 30% over 3 years for customers who never switch, even if their driving record stays perfect. No accidents, no tickets, just loyalty. And it costs you hundreds, sometimes thousands of dollars. The fix is absurdly simple. Shop for new insurance quotes every single year. It takes 20 minutes. The average person who switches saves around $416 annually. That's not a small number. Over a decade, that's over $4,000 for 20 minutes of work per year. But only about 12% of people actually do this. The rest just auto-renew, again and again, paying the loyalty tax. Next up, the money mistake hiding in plain sight in your paycheck. Fix number 3. Your tax refund is not a win. Americans love tax refunds. The average refund is around $3,000. It feels like free money, like winning. But here's the reality. A tax refund means you gave the government an interest-free loan for an entire year. You overpaid your taxes, paycheck by paycheck, and they're just giving you your own money back. No interest, no thank you, nothing. Now imagine you had that $3,000 throughout the year. Broken down monthly, that's $250. You could have put it toward high-interest debt. You could have invested it. You could have avoided overdraft fees or payday loans during a tight month. Instead, it sat in the Treasury's account, doing nothing for you. If you're carrying credit card debt at 20% interest, which 45% of Americans are, that $3,000 refund represents about $600 in lost opportunity every single year. The fix? Adjust your withholdings, file a new W-4 with your employer, claim the right number of allowances so your paycheck is accurate, not inflated for the government. Most people don't do this because they think of their tax refund as forced savings, which it is, but it's the most expensive savings account you could possibly use. Okay, this next one might actually make you angry. Fix number 4. Minimum payments are designed to keep you in debt forever. Credit card companies are required to show you a minimum payment on each statement. It's usually around 2 to 3% of your balance. Seems reasonable, manageable. But here's what they're not required to show you clearly. If you only pay the minimum, you'll be in debt for decades. Let's run the numbers. Say you have a $5,000 balance on a card with 18% interest. The minimum payment starts at around $150. If you only pay that minimum every month, it will take you 17 years to pay off the debt. You'll pay over $4,000 in interest, almost as much as the original debt itself. The credit card company doesn't want you to pay it off quickly. They want you to pay it off slowly, very slowly, because that's how they make money. But here's the darker part. Minimum payments decrease as your balance decreases. So in year 5, when your balance is down to $3,000, your minimum payment drops to $90, which sounds good until you realize it means you're paying even less toward the principal. The debt lasts even longer. It's a trap with a smile. The fix? Ignore the minimum payment. Pretend it doesn't exist. Decide on a fixed payment that you can actually afford, ideally 10 to 15% of the balance, and pay that every month, regardless of what the statement says. A fixed $200 payment on that same $5,000 debt gets you out in under 3 years and saves you over $3,000 in interest. Same debt, different strategy, completely different life. And finally, the money fix nobody talks about because it sounds too boring to be important. Spoiler, it's the most important one. Fix number 5. Manual money management is sabotaging you. Humans are bad at repetitive financial tasks, not because we're dumb, because we're human. We forget, we get busy, we convince ourselves we'll do it later, and later never comes. This is why the most powerful money move you can make has nothing to do with discipline and everything to do with removing yourself from the equation entirely. Automate everything. Savings, investments, bill payments, debt payments, all of it. Research from the National Bureau of Economic Research found that people who automate their savings save 27% more than people who manually transfer money, not because they earn more, not because they want it more, but because the systems become automatic. Here's why this matters so much. Every time you manually decide whether to save money, you create a decision point, and decision points are vulnerable. You had a bad day, you saw something you want, you tell yourself you'll catch up next month. Automation eliminates the negotiation. The money moves before you can think about it. The same applies to debt. Automated payments mean you never miss a due date, which means you never pay a late fee, which means your credit score doesn't take a hit, which means you qualify for better rates on everything, from mortgages to car loans. It's a cascade. One small system change creates compounding benefits for years. But here's the catch. Only 38% of Americans have automated their savings. The rest are still doing it manually, still relying on willpower, still losing. So let's zoom out. These 5 fixes, where you park your emergency fund, whether you shop for insurance, how you handle your tax withholding, how you pay down debt, and whether you automate your money, are not sexy. They don't involve crypto or day trading or side hustles. They're boring structural changes. But here's what they actually do. They fix the math. And the math is what matters. Because personal finance is sold to us as a story about character, about discipline and sacrifice and delayed gratification. But it's actually a story about systems, about who designed them and who benefits from them. Most people are losing not because they're weak, but because they're playing a game where the rules are deliberately unclear. These 5 fixes don't require you to be a different person. They require you to understand the game well enough to stop losing by default. Alex, the guy from the beginning, eventually figured this out. He opened a high-yield savings account. He started shopping for insurance. He automated his debt payments. His spreadsheet got less impressive, but his bank account got bigger. Not because he became more disciplined, because he stopped fighting systems that were designed to quietly take his money. The question is, how much are those systems taking from you? If this changed how you think about money, hit the like button, drop a comment, and tell me which fix you're implementing first. And subscribe, because we're just getting started breaking down the systems that shape your financial life, whether you know it